Hello and welcome back, guys. So in this particular session, what we will be doing about is TYU 7 in case of FR, financial reporting, F7 of ACCA. And then let's look at the question and then let's move on. So we have a associate subsidiary and a parent company. Okay. So after that, what we've been given is that we've been given the PPE. So PP is given, and then investment is given, and then associate is also given. So share capital is given, return earning is given, liabilities is given, and then we have our SOPL as well. Okay. So what we will do is that let's look at something else. So what about this thing? So shares in A and S and A were acquired on this date when the retained earning were 15,000 and retained earning of A were 10,000, right? And then after that, at the date of acquisition, the fair value of S non-current assets, which has a remaining useful life of 10 years, exceeded the book value by 10,000. So S sold goods to H 10,000 at a margin of 50% at the year end, right? And then after that, at 30th June 20x9, the goodwill in respect of S has been impaired by 30% of its original amount, of which the current year loss was 1200. So 1200, and then investment has also been impaired. Okay, so let's redo our standard pro forma working note 1. So what will be our working note 1, which is structure. So since there is a subsidiary, and so when will the company be a subsidiary? When the company has control over the entity. So when does the company have control? So I'll write that thing down as well. Control. Okay, so when it is subsidiary, it has control. Okay, so subsidiary when it has control. And then what are the criteria for control? Is that the investor has power over the investee. Okay, the investor has right or is exposed to variable returns from the entity, from the investee, or from the entity, you can say that as well. And then the third criteria is that the investor can use its power to affect the variable returns. Okay, returns. So these are the three criteria. And then what is control, you might say? So control is anything which allows us. So there is also a criteria for what is power. So when will there be a power over investee? So when they have a significant voting rights, and then when they have a convertible rights which gives them more than 50% of shareholding, and then after that I'll write down that thing as well, so that will be easier for us. So control, and then criteria for power over investee. So in this particular case, what is essential is that will they have a power is that when the entity has significant voting rights. Voting rights. Voting rights, right? And then after that, the shareholding is less than 50, but the other shareholders are largely dispersed and are of unconnected goods. Okay, and then after that, the agreement between shareholders. This is also another important criteria. Okay, so that's pretty much it, I guess. Yeah, so subsidiary and then parent. So when it is called subsidiary, when they have a control. Okay, so how much is their holding percentage? Does it say anything? 100%, right? In case of subsidiary. Associate is, so what we will do is that, so 100%, 0, and then associate is, how much is it? 30 or 40? 30%. Okay, so 30. Sorry. Calculation of subsidiary. Calculation of subsidiary. So at at reporting post acquisition, right? And then after that, we'll prepare the same thing for associate as well. Associate, and then after that, share capital. Does it have a share premium? Let's look. So no share premium. Okay, so let's look at its share capital. 75 and then 51. Okay, so 75 and 51. 75,000, 51,000. So is this figures in thousands? Is this figures in thousands? No, it's not in thousands. So what else? So has there been any fair value adjustment? So yes, there is a fair value adjustment. Remaining useful life of 10 years exceeded the book value by 10, right? And then what was the retained earning? 15,000. So 15,000. It was 15,000 and then it improved to 51,000, right? And then after that, fair value adjustment, which is for plant, I guess. Plant, and then depreciation. So another thing that we need to remember is when was the acquisition? When did the acquisition take place? So 30 June 20x9, right? And then after that, on 1st July 20x6. Okay, So how many years? How many years? So 1 year from June, from 30th June 20x6 to 2017 30th June 20x6 to 1 year till 2007, and then after that 2007 to 2008 is 2 years, and then after that 2008 to 2009 is 3 years. Okay, so it's 3 years. Okay, so 10 10,000, and then after that 10,000 divided by 10 into 3, right? 3 years have gone by, so minus 3, and post acquisition profit is this minus this. Okay, so let's do the same for same associate. So what was the share capital? 35 and 34, right? 35 and 34. 1,000, 34,000. So, okay, so that's done. 35,000, and then after that retained earning. What was the retained earning? So retained earning is when it was acquired 10,000. Okay, so 10,000, right? Anything else that we are given? So S sold goods to H, subsidiary sold to H. Okay, so 10,000 at a margin of 50, so 5,000, and then 80% of those goods were sold, 20% is remaining. Okay, so what we can do is that so what we will do is that PURP, right? Less PURP. Around over here, what we'll do is that calculation of PURP. Okay, bold working. I think it will be 7. So bold, and then after that, I'll just use my standard format. Total goods, and then sold goods, then remaining goods cost, and then selling price. Selling price. This will give us PURP. So selling price was 10,000, I guess. 50% margin, 80% sold. Yeah, 10,000, 50% margin. Okay, 80% sold. So 10,000. Then after that, our cost is this into 0.5, and then after that, sold goods is this into 0.8. And same thing for the selling price as well. So remaining goods being this minus this. So this minus this. So that's how PURP. Okay. So remaining goods is 8. So the cost was 5,000, and then after that 80% among it is 4,000, which is sold, and the remaining goods is 1,000, right? So if this parent sells it, then only it will be realized. So since it has not sold it yet, so that's 1,000 profit has not been realized. Okay, so having said that, what I will do is that I'll just link this cell together. So and then minus, so just leave a capital, something easier. Okay. that's it for working note 2, I guess. 3. Calculation of goodwill. So what's our cost of investment? So in this particular question, so we are not given cost over here in our additional information, but we have been given the cost in non-current assets investment. So this is always a good trick to find out. Sometimes if it's not given, then this is where you look at. Okay, so 115, right? So 115, so 115,000, and then after that fair value of rolling interest, right? So how much is it? So additional information. So does it say anything? Oh, no, because it's a subsidiary which is 100% owned. That's why it does not have any fair value of NCI. Okay, net assets at acquisition. So acquisition, and then after that, this figure plus this figure is our total, and then we reduce minus this net assets of subsidiary, total goodwill at acquisition. So this will be this figure plus this figure, right? And after that there has been an impairment as well. Impairment, which is 30%, I think. This into 0.3 is it? Let's check it out. So it says impairment has been impaired by 30% of its original amount, of which the current year loss was 1200. So current year loss was 1200, right? So that means, so 4500, this minus this 3300 had already been impaired before, but we will only use that 1200 in SOPL, okay? Because in SOP it's a cumulative figure. Reporting date, minus, so this figure plus this figure should give us our goodwill. Let's bold it, will make it look nice. So what I should do is that then Control C and then Control V. So done as well, and then bold this thing. Calculation of net assets of subsidiary, calculation of net assets. Okay, so don't forget all these simple things, very important. Associate, and then sometimes even if you make a mistake in like your thingy calculations, but if you actually show the process of taking a shortcut, then they will give you marks. Okay, they have to give you marks. So since there is no fair value of NCI, so we don't need to we don't need to calculate NCI. Okay, so otherwise our working note 4 usually used to be about NCI, right? So we are going directly to group reserves, right? So group reserves will be 100% of parent. In this case, 100% of parent is equals to, what's the parent's retained earning? 89,000. 89,000. Okay, so share of post acquisition profit of subsidiary. So we will lose that. Merge the cell, text wrap it just to make it look nice. So this is the post acquisition profit, and then multiplied by What else? 100%. That's our holding percent, right? In case of subsidiary. And then, has there been any impairment of goodwill? Impairment of goodwill. And then that less. Let's move this down because we have associate as well. V and then C V associate as well. And after that, impairment of goodwill is this figure into our holding percentage is 100%, right? So that's our impairment, right? And then after that, so there has been impairment of investment or not. We need to check that thing out. So what's our post acquisition profit? So see, it says 26,000 over here, whereas it says 24,000 over here. So always use this figure. So it's always good to calculate net assets of associate as well. Okay, so this figure into 30%, right? Our holding percentage. So once is a mid-year acquisition, then there has to be time proportionate basis as well. So since it is 3 years ago, so nothing to worry about. If there has been a mid-year acquisition, we need to time opportunities at it as well. Okay, so let's see what has happened with our investment. So impaired by 150, current year loss was 150. So impaired by 450, current year loss was 150. So let's see. So in case of impairment of investment, right? So this will be minus 450, right? Minus 450. That's pretty much it. So I'll just leave a few gap so that if I miss something, I can write it down again. So working note 5, okay? Working note 5 total. Just add it up, sum everything, sum of all these things, 123250, hold it, and then in note 5 will be investment in associate. So in this case, bold cost, and then after that, share of profit, and after that, less impairment of investment, less URP if parent is seller. Okay, and after that, that's pretty much it, I guess. Total. So how much did we pay for it? It's in our balance sheet, 15,000, right? 15,000, we paid that much. Share of profit will be this into this figure, pretty same over here, and then over here should be same because this will be going to our asset sides. This is already in our left hand side, in our equity side, right? So this should equal this figure anyway. So and then impairment of investment is minus 450, right? And then URP is not there. I think that's pretty much it. So hold it, sum 750. This is working 6, and then prepare our consolidated financial statement. Let's prepare it side by side so that it's easier. It's consolidated, consolidated SOFP. Hold it, non-current assets. Hold it, goodwill. Working note 2, and then let's link it up as well. The figure, what do we have over here? Property, plant and equipment, PPE 87 and 88, right? PPE 87,000 plus 88,000, right? Plus fair value adjustment. So what happened when this is the figure that we add plus increase the depreciation, right? Excess depreciation. So that's there. And then what else do we have? Investment. So investment. So this is the usual thing that I use is so 5 and 115, right? So 105,000 plus 15,000 minus. So I'm checking like whether the investment has been on any other company or not. So even like it might be in any financial asset or whatever, like in any kind of financial asset, or any financial instrument, whatever you want to call it. So what we do is investment figure minus, we exclude the investment made in subsidiary and associate. Okay, so minus this figure minus, so normally it will be over here, so that's 0. Okay, so we just don't want to miss it. That's why I use this technique. If you like it, you might use it as well. So associate as well. Okay, let's link it up. 21,750. Right, and then after that, what else? Total assets, I mean total NCA. What I'll do is current assets, and then after that will be, so what do we have in current assets? 74 and 40. So 74,000 and 40,000, right? So current assets is 70 and 40. So 70,000 plus 40,000. That's our current assets. And then is there anything else? Yes, there is. Is there any PURP? Yes, there is some PURP, I guess. So what's our PURP? So minus 1,000. So we do have a PURP, which is reducing the inventory. Okay, so the entry would be debit PURP, credit inventory, right? So what about the mutual owing? So has there been any other group intra-group transactions? No, it does not say anything about that, right? So that's out of the way now, so we can move on now. Total assets. So I'll just bold it again, and then after that some. That's our value. Check app. Capital is, how much is check app? Correct. 200,000. 200,000 reserves. I'm missing something over here. In 5. This is from working mode 2, and reserves is from working mode 4. Let's link up again for group reserves. So this is the figure, and then after that let's sum this up plus this figure. So that's our total equity. So NCI is not there, but still I'll put it. And then liability. So in case of liability, is there any liability? Let's check it out. 2000, 2000, 4000, right? Current liabilities. 2000, 2000. Hey. So is there anything else that I'm missing out? I think I'm missing something. I don't know, I just get the feeling that I'm missing something because my balance it does not match. So total and liabilities, right? So what am I missing? What am I missing? Everything is done. What am I missing? Okay, let's check it out. 30%, okay, it's done. So is there anything else over here? 3000, right? Subsidiary sorted to this. So there is a PURP, but what's the PURP amount? Into 30%. So what about now? So PURP will be no, in this case it's 100%. So this is not that. Okay, so this looks alright to me. Anything else that I'm missing? What am I missing? Group reserves seems alright to me. So share capital, has it been recorded? No, share has not been issued. So what about the values? Let's check one more time. Linking wise, it's good. Share capital is also good. Current liabilities, group reserves is good. Current liabilities, share capital is good, I guess. 200,000, right? 200,000. 200. Where did it go? 200,000. Current liabilities 2,000, 2,000. So no mutual owing. So no cash in transit or anything of that sort. So Nothing of that sort, right? 2000 is there. So what about current liabilities? So current liabilities is 70 plus 40, right? Minus PURP. So that's 74 plus 40. Oh, this should be 74. Good. So basically that's PURP. We are reducing it from inventory, right? So let's prepare consolidated SOPL. Our SOFP is finished. Could be revenue. We have profit. So what's our revenue? Let's look at it. We need to consolidate it so it's not mid-year acquisition, so no need to worry about time or percentage basis. So 500,000 and 200,000, right? So 200,000, so that's only 50,000 plus 200,000 minus what has been the intra-group transaction is 10,000, right? Minus this figure, the selling price, because it was a revenue for one organization, so we need to eliminate that. So operating cost does not have any operating cost, which will be equals to this figure plus this figure, 400,000 plus 140, 400,000 plus 140,000, right? And then after that else, so let's eliminate this 10,000 because there is cost of sales in that 10,000 as well. And then after that let's add what else? So was there any impairment? So what else? Impairment. Yep, there was an impairment of 1200 for current year, I guess. So 1200 was the impairment, and then in case of investment as well, there has been an impairment which is not mentioned, which will not be over here. And then there is a PURP of 1000 plus 1000 worth of things still over there. So 1000 worth of inventory is still over there. So that's it. This minus this is our profit. So what happened? So this is 0, and then share of profit, right? Associates profit. Associates profit is 26,000, right? Into 0.26,000 into 0.30. And then has there been any impairment? Current year 150. Alright, so 150 will be deducted from here. 7650 is our associates profit. Then has there been anything else? Impairment of goodwill. That's already been gone, isn't it? Did we not charge it? Yes, we did charge it, 1200 already. So that's our operating profit, or profit before tax. This figure plus this figure, and then after that tax is tax. So 23 and 21. 20,000 plus 21,000. Right, so this figure minus this figure is our PAT, profit after tax, right? So OCI is not there, 0. Total comprehensive income is this NCI attributable parent NCI, right? So there is no NCI, so no need to worry about that. So normally, otherwise, what you do is this minus your NCI value, and that you give you the parent's income. So that's it, pretty much, guys. So that's all. Yep, that's it. So this is how you actually account for this kind of problem. So always you need to be careful about these intra-group transactions, and then after that deduct that intra-group transactions, deduct your impairment, or I mean impairment of goodwill. So since it is in operating cost, you could make a different heading and then charge it that way as well. Doesn't really matter. And then after that PURP will be added, and then after that your thingy will also be added. Okay, your number of inventory will also be added. Okay, so that's pretty much it, everything else. And then you deduct any impairment on your investment, so which is only for current year, and then all the cumulative balance will only be in SOFP. Okay, so this is how you account for this kind of problem. So we will also look at few other questions, so that should help us out a bit. So that's it for today, guys. Until next time, bye bye.